welcome to Listen to the Market for February 27, Monday. Today we'll give you a great opportunity to expand your knowledge database in terms of some aspects of campaign management, i.e. flexibility. Flexibility in terms of how to manage your campaign and flexibility in terms of where and how to place your stop losses. All courtesy of the market price action on Monday. Let's start with Monday. Normal routine, top-down approach. Previous day's highs are marked, previous day's lows are marked, and the message from Friday for Monday was on two levels. Number one, expect a larger range than Friday, and number two, probabilities favor the downside. Let's see how it worked out. Well, it's almost as if someone rang the starter's bell or fired the starter's gun. Right on cue, a FO sell in the optimal time window on the 60-minute, reinforced by FO sell on the 30-minute, and you guessed it, another FO sell on the 15. The fractal nature of markets. What you see on one time frame, you see on another time frame, and a third time frame. Now, one aspect in relation to the L.I.V.E setups that one initially may have a challenge with is a white bar with a higher high and a higher low being a sell. Yes, indeedy. Not bearish, but a sell setup. So on the 15-minute, you're looking to enter short down below there, around the 34.51 level. ISL above there, 34.64. So a risk factor of about 13 pips. The market was kind. Entry was facilitated by opening in the range. Part of the entry mechanism rule set broke down to trigger your sell level, so you're currently short. ISL was at the high and it wasn't threatened. The market gives you a lower high, so simply lower your stop loss to a trail. Next bar gives you a lower high, lower low, lower close, all is well. So your stop trail now becomes a true trail, locking in a few pips in terms of profit. Unrealized, of course. The 30-minute bar has now finished, and that's the view from the 30-minute bar. It too is a promise of lower lows. Bear in mind the 60-minute is yet to complete. Next bar comes along, we have a lower high. Again, lower the stop loss on the 15-minute. The 30-minute hasn't enabled you to roll it out. Next 15-minute bar comes along, well, the stop has to remain about there. How about on the 30-minute? Well, the 30-minute, those highs are those highs. You recall at the beginning of this video I mentioned flexibility. Rather than managing the position as one whole, why not split it into two halves, and run different stop losses? For example, run one stop loss at break even, and one down here on the 15-minute or even the 30-minute. The level down there protects a 1R return, so should you be stopped out, you make a 1R return on half, continues going up, you get a break even on the other half, so your net result is 0.5 of an R for one campaign. Let's move forward with the 30-minute. The 30-minute shows that one's been stopped out on the basis of breaking that high. The break even hasn't been threatened. What do you have on this 30-minute bar? You have an RTV sell. So you can look to reinstate that short position with a move down. The 60-minute by now is giving you that picture. The 60-minute also, the high is too high, it's back up there, it's back up there. So to manage it on the 60-minute basis, nah, you're giving back too much at this stage. Next bar comes along, and what do we have in relation to the 30-minute? Well, you've entered on the short side. The hour is complete. Let's have a look at the hour. Well, the hour is also an RTV of a previous high. So nice, we can look to add again on the breakdown through there. We can look to manage that position on the 30-minute basis. And bear in mind, we still have a core position way up the top there. So what I'm introducing now is the flexibility of how you manage your campaign by splitting, by adding, by looking at the different time frames, and that way you have the ability to do rather nicely as the market continues moving in your favor. One big reason to look to do that yesterday was the fact that the daily view presented probabilities favouring the short side. So what I'm introducing is the flexibility rather than choices. The market provides the choices. You have the flexibility whether you wish to go with it or not. Worst case scenario, entry was there, the entire lot was liquidated there, and you ended up with a 1 hour return for that short campaign. You may recall last week that I mentioned a student who's done the L.I.V.E program, who'd ventured out on his own trading the Euro-USD dollar pair, and jokingly I said that he had a TGIF day on Friday and didn't trade at all. Well, we were speaking over the weekend, and he suggested that to make him totally accountable for his actions, he'd like us to monitor his performance week by week. Trading really is the ultimate in accountability for self. There's no getting away from the daily report card, the weekly report card, the monthly report card, in terms of how well or otherwise one has done in following a rule set or indeed trading. In order to gauge a performance, I always urge one to look at a baseline account, a baseline equity graph. And the baseline equity graph simply reflects trade by trade what the outcome would have been in an ideal scenario, following every setup, taking every signal, not accounting for slippage, not accounting for the real life vagaries of internet outages or computer issues or even a TGIF day. That way there's a yardstick to compare the actual result to. So you'll see here the student had 15 campaigns last week versus 20, or quite simply that's because he took Friday off. His return was 4.68R for the week versus the baseline return of 6.06 for the week. So he's down a little bit. The strike rate, that was quite nice, 60%. Maximum wins in a row, you can see they clustered in through there, 5 wins in a row. Maximum losses in a row, you can see a little cluster of losses in through there, likewise a little cluster of losses in through there. So what he's done is managed to match the account pretty well. The baseline account had a 1 hour loss, so in other words the full quota being stopped out at ISL, and he didn't encounter that himself, so he managed to beat the baseline in that regards. There's your example of a drawdown in through there, and it took 1, 2, 3, 4 campaigns in the drawdown before it came out of the draw. In here there was 1, 2, 3, 4 again, and then out of the draw. Over here in the baseline there was 1, 2, 3, the fourth one came out of the draw. So a little bit of a disparity in through there. The bottom line is to see whether it's a marathon or a sprint. Are you in the markets for a good time or for a long time? Or for a good long time? So that choice is yours. So next week, every Monday, I'll be going through a little segment just updating you on the actual performance, real time, real money, applying the L.I.V.E rules, the L.I.V.E setups, the L.I.V.E concepts. That's it for Monday's report. Over and out.